Let's bring in Chris Ailman, the Chief Investment Officer of CalSTRS. Welcome back, Chris. It's great to see you. This market, investors are doing a lot of gaming out of scenarios, whether it's the president's health or the election odds or stimulus. And they're looking at it with a glass half full. It's a pretty rosy scenario, at least according to the price action. Where are you on some of these risks we're facing?
Well, I'm right in the middle of half full and half empty. Personally, I think I'm pretty concerned about the risks in front of us. The fact that the market is so top heavy in the famous 5 stocks. But it's good to see the small caps do well today. So I think that's healthier for the market. We need a stimulus. The bottom line is it's a health crisis, and the health crisis is far from over.
And yet the stock market is up 55% from the March lows, Chris. What is your allocation these days to equities and specifically U.S. equities? And do you have enough of them given this fierce rally?
Well, Sarah, we're actually aggressively neutral, which I know is a funny saying, but we are right on the mark at our equity allocation, both U.S. and non-U.S. We're actually at the mark in fixed income, real estate, private equity, infrastructure, all the different parts of our portfolio. We don't really want to be in a position to be overweight or underweight, taking bets in this kind of a market, because you can't fight the Fed. So while there are risks around us on all sides, we have a very balanced portfolio. And I think we have the adequate level of equities that I'm comfortable with. I'm not comfortable with the concentration that we see in these top 5 names, but they're profitable companies. So we're going to stay invested. And yet at the same time, balance the portfolio with other types of assets that give us diversification, like fixed income. You were talking to Rick Santoli about the low rates that we're seeing, but we think that that's still going to be an area we can invest in. And then other strategies that give us diversification.
Are you confident those fixed income holdings you have will give you a positive real return over the next decade?
The next decade, Wilford, that's a tough call, but yes, I am. I think that we saw after 2008 that the Fed is able to unwind its balance sheet slowly. I'm not concerned about negative real rates at this point in the USA. But we only have about 12% of the portfolio in fixed income. So you compare that to the old days when pension plans were 60% equity and 40% debt. Over the last 30 years, our fixed income exposure has declined as rates have declined. So we have to use other tools to diversify the portfolio.
Shepard Smith here. Thanks for watching CNBC on YouTube.